Let's talk about the thing most crypto guides skip over: tax. If you own Bitcoin in Australia, the ATO has a view on it. Ignoring it is not a great strategy because the ATO has been actively asking exchanges for user data and issuing letters to crypto holders for several years now. This video covers the basics of how Bitcoin is taxed in Australia, so you know what questions to ask your accountant, and yes, you should have this conversation with your accountant. This video is general information. Your specific situation is a conversation for a licensed professional. Let's get into it. The single most important thing to understand is this. In Australia, Bitcoin is not treated as a currency. It's treated as property, specifically a capital gains tax asset. This is the ATO's official position, and it has been since 2014. What does that mean in practice? It means that every time you dispose of Bitcoin, you may have a tax event. Dispose here includes selling Bitcoin for Australian dollars, trading one cryptocurrency for another, using Bitcoin to buy something, or gifting Bitcoin to someone. Each of those is potentially a taxable event. The tax is calculated on the difference between what you paid for the Bitcoin and what you received when you disposed of it. That difference is your capital gain or capital loss. Here's a simple example. Say you buy $1,000 worth of Bitcoin. 6 months later, you sell it for $1,400. Your capital gain is $400. That $400 gets added to your taxable income for that financial year and is taxed at your marginal rate. So if you're on the 30% tax bracket, you'd pay $120 in tax on that gain. Now here's the discount. If you hold the Bitcoin for more than 12 months before selling, you're entitled to a 50% capital gains discount. That same $400 gain becomes a $200 assessable gain. Your tax drops to only $60. Now you might be wondering, what about capital losses? If you sell Bitcoin for less than you paid, you have a capital loss. You can't offset that against your regular income, but you can use it to offset capital gains either now or in future years. You might be wondering, how does one keep track of all their gains and losses? Well, the most important part is to keep clean records of your transaction history. The ATO requires you to keep records of every crypto transaction. That means the date of each purchase or sale, the amount in Australian dollars at the time of the transaction, what you paid in fees, and any receipts or exchange confirmations. Bitcoin's price can move a lot in a year. Knowing your cost base, the Australian dollar value at the time you bought, is essential for calculating your gain or loss accurately. The good news is that if you use a regulated Australian exchange like bitcoin.com.au, your full transaction history is available in your account at any time. You can download it and hand it straight to your accountant. If you've used multiple exchanges, bought Bitcoin peer-to-peer, or received it in other ways, your record keeping becomes more complex, which is where using crypto tax software, like some, may come in handy. There is one exception worth knowing about. It's called the personal use asset exemption. If you buy a small amount of Bitcoin with a value under 10,000 Aussie dollars, specifically to make a purchase, and you spend it promptly, the ATO may treat it as a personal use asset rather than an investment. In that case, the CGT rules don't apply. The key words are small amount and promptly. If you're holding Bitcoin as an investment, then use it to buy something, the exemption almost certainly doesn't apply. This is a nuanced area, so don't rely on this exemption without professional advice. Inside a self-managed super fund, the tax treatment is different and more favourable. Capital gains inside an SMSF in the accumulation phase are taxed at 15%. If you've held the asset for more than 12 months inside the fund, the capital gain tax is reduced to only 10%. Bitcoin inside an SMSF must comply with the fund's investment strategy, be properly documented, and be held in the name of the fund's trustee, not in your personal name. This is absolutely an area where talking to your accountant and financial advisor first is essential. If you trade crypto very frequently, the ATO may determine that you're running a business rather than investing. In that case, your gains will be treated as ordinary income, not capital gains, which means no 50% capital gains discount, and the tax treatment is less favourable. There's no hard and fast rule on how many trades tip you into business territory. The ATO looks at things like how systematic and frequent your trading is and whether you're seeking to profit from short-term price movements. If you're buying and holding long-term, this almost certainly doesn't apply to you. If you're trading frequently, definitely talk to your accountant. Right, here's the practical checklist. 1. Keep records of every transaction. That includes the date, transaction type, AUD value at the time of the transaction, and any fees paid. Number 2. Calculate your capital gains, losses, and income from all your activity. You can either use a spreadsheet to manually do the calculations, or you can use crypto tax software like some, which automates a lot of this process. 3. If you've held Bitcoin for over 12 months before selling, you may be entitled to the 50% capital gains discount. And don't forget, you can use any capital losses you have to offset your capital gains either now or in future years. Number 4, if you hold Bitcoin inside an SMSF, the rules are different and the compliance requirements are stricter. Number 5, tell your accountant every year. Tax is one of those things people put off thinking about until it's urgent. And with crypto, the records you don't keep in year 1 are the ones that bite you in year 3. Get your records in order, consider using tax software like some, and talk to your accountant. And if you haven't started yet, bitcoin.com.au is the AUSTRAC-registered starting point
that many Australians use.
Thanks for watching, guys. We'll see you in the next one.